Let's take something really, really complicated and make it really, really simple. Hey everybody, this is Spooky, and I'm back for the next episode of the Rags to Riches $500 5-year challenge. And one of the most common questions I've gotten lately is what to look for when I'm looking at both companies to trade, companies to invest in, and well, both means too, but we're going to throw an extra one in there. What do I look for dividends? Specifically, a couple people are in Europe and they're not necessarily offered the same selection as we are here in the US. So let's go ahead and get my face out of the way. And first, I'm just going to recap really quick what I did on the account. You can see here it says open is $46 in the red. So overall, I'm down 4.85%. That's still much better than 90% of new traders. But the purpose of this here is that it's all investment, and I don't necessarily care about the noise. I don't really care what the price does because I'm not selling anything. So I'm planning on holding these for a long time. In fact, I actually bought some more of Tesla this morning because I had about 70 some odd dollars worth of profits left over. And let me do that really quick as well. So looking at the spreadsheet here, realizing that we're in the month of October, the contribution for this month was $700, bringing the total contributions to $1,200, which means I should have only been speculating with about $360. And I looked at the settled funds and the unsettled funds, and I added them together, and it was about $70 higher than this. There was about $430 in the cash realm. So that told me that I needed to shift some of those profits over to the investment side, because I don't really care how big this dollar amount gets. I care that this one stays the same size so that I can trade reasonably and not lose those profits. So that's all I did today. I picked up 4 extra shares of Tesla, and you can see here, I started with 7 and now I have 11. So the total investment there is $143.66, bringing the total investment dollar amount up to $933.74 instead of the $840 that we had from contribution. So we're already speeding up this process, and that's pretty good. We're 2 months in and we're doing okay. Now, Tesla, of course, is one of the more aggressive ones, so I wanted to kind of build that one up a little bit more aggressively at first, but I will be dialing back and putting other positions in the spotlight when it comes to those extra profits and contribution priority. Okay, so let's go ahead and look overall. I lost about $12.64 today. I had a little bit of a snafu there with one of the runners. I just got stuck in it. They went down. I sold. No emotions, no questions asked. I simply took the loss. And since I'm not re-entering that one for another month, I'll get it right back at tax time, and I can put it right back into my portfolio, so I don't care. That's what it's all about. Okay, so let's go ahead and look at some of the complicated stuff. So first, what do I look for in companies, right? If I pull over FinViz here, this is probably the first thing that newer traders are exposed to when it comes to finding companies. They typically stumble across a screener like this, or they're introduced to it as part of an education course, like we have the PB University. And screeners are amazing. They're really good at helping you figure out what you want to look for in a company. So if I click all here, for example, I have all these things that I can choose from that'll filter down the stocks that have those properties, and then I can look further into those. And building screeners is, in its own right, a separate art form, and we'll get into that later on in the series. I kind of already have my stocks picked out that I'm going to be looking at. So let me just go ahead and pull up Microsoft here, because it already has, it's like the gold standard. IBM and Microsoft are 2 very, very good stocks for both investment as well as dividends. So this is a lot of numbers. It's a lot of weirdness, right? And I wrote a browser add-on that kind of highlights things based on the range that they're in compared to what I like to look for. So in this case, PE is over 15, so it's 33.73, therefore it's green. Quick ratio, current ratio, I like to see those over 1, so it's yellow, but it's not green because it's not over 2. So I like it, but it's not where I want it to be. All right, so we can skip past that. Institutional ownership here is a good one. There's any variety of numbers here that you can look at and say, oh, this is a good investment or a bad investment. Nobody's ever going to care about all of them. Okay, what I do care about is that something is shortable, because that means that it has a mechanism built in with the market that can keep the price in a healthy range, which can potentially disrupt things like buybacks, any sort of dilution catalyst. I don't really like those, especially when it comes to dividend stocks, because it messes with the number of shares that I have. So it doesn't necessarily affect the dollar amount, but it muddies the water. So I don't like that if something is not shortable. I also care about the float obviously, the float and the outstanding shares. Now, I don't want to see a huge gap between these, and that's just because outstanding shares are the total number of shares a company has created. It doesn't necessarily mean that's part of the circulation in the public float. The float is what's available for you and I to trade. So any difference there is usually restricted shares. They might be part of like an employee benefit package. They might be part of a private sale. There's all kinds of weirdnesses that can happen there. So I don't like to see these numbers too far apart. All right, one of the other items that I like to see is average volume. That's kind of relational to the float, so you don't really have, like, that's not a deal breaker. I just like to see that something is relatively active. There's liquidity if it's something that I plan on using, let's say, the wheel strategy on. If I plan to actively trade those shares to speed up the profits, the passive profits, I like to see that there's enough liquidity, which means that my options contract specifically won't be affected too poorly, okay? So it doesn't really matter too much, but again, that's if I'm planning on doing the wheel strategy for these positions, that is something I want to be aware of. All right. Don't really care about too much of the rest of the stuff. I mean, I could go through each one and tell you exactly what they are and how they matter, but ultimately it's up to you to kind of figure out which ones you care about. Good institutional ownership is always good. Insider ownership is all right. It's not a deal breaker. Low is typically not great, but again, that boils down to how big this number is and stuff like that. So don't necessarily hinge everything on these numbers. Half the time they're not even accurate on FinViz, so keep that in mind as well. Now this one does offer a dividend and it's 2.86, but there's a better resource for these. And I found out a couple of the people on my team here weren't aware of this site. It's just stockanalysis.com. And in here, you'll see, like if you pull up Microsoft, right? I'll type in Microsoft here. There's all kinds of tools here that you can use. Now, the news and stuff, I don't really care too much about. This isn't the best source for news. It's not necessarily the worst, but it's just Business Insider for the most part and CNBC. So nothing really crazy. There are some tools here on the left side. There's a stock screener. Earnings calendar is great if you're somebody who likes to trade earnings. There's an ETF screener here. There's IPO calendars and stuff like that. So definitely worth looking into, but I like FinViz for screening specifically, or Stock Fetcher. That's a paid subscription. But once I get the stock, this is what I use to look through it. Okay. So you're going to see these tabs here. Once is overview, financial, statistics, forecast, dividends, profile, and chart. If you're someone who's just looking for investments, just looking to find good, solid companies, you're not going to care about the chart too much at first, right? That's kind of the last thing we look at. Overview is pretty good, right? You can look at the market cap, you can look at the revenue. This is important, but we're going to get into that in a second. The 52-week range is kind of important a lot of times if something is in a strong trend, just so you can kind of see how much it's breathing, but that's typically not the case if you're looking at a good company. Never, ever, ever pay attention to these analyst ratings. They use an outdated DCF model. It just doesn't make sense. But for some reason, they still have influence over the market and headlines and things like that. So I never pay attention to them. There's also better sources for these things. I want specific price targets in that case. Again, it does have a dividend date, and you'll see the ex-div date right here. So I know that if I buy this stock and hold it before November 19th through then, through the record date, I will get paid for the shares that I own, $3 each. After November 15th for this stock. Now, that's only if I care about the dividends. I don't really care about that too much for this video. What I do care about are the financials. So if you're someone who's used the SEC database before, and to get there, you just go to sec.gov, you click filings, or you put your mouse over filings. I'm sorry, if you click it, it brings you to another page. So put your mouse over filings, this menu will appear. Click on company filing search, and make sure you bookmark this page so you don't have to keep going back to it. All right. And then just type in your ticker that you're looking for right here. And you can click on that or hit enter. And then right here is where you're going to find all the SEC filings. You have your 8Ks, which are your announcements and shareholder disclosures and things like that. So when a company gets in a deal, they have to publish it. If they put earnings out, they have to publish it. They have an obligation to inform shareholders, and they do that through 8Ks. And then there's the earnings report, or I'm sorry, the quarterly and annual reports that are the 10Ks and the 10Qs. So 10Ks are yearly, 10Qs are quarterly. We'll get into all that later. I don't really care about too much other than we're owed a quarterly pretty soon. Right, so pretty soon we'll get another one, but we're going to close this site right here. This is only if you really want to dig in and make things really complex. Now, if you are someone who's already acclimated to SEC filings, this is great because I know for a fact I can go to this 10K here. I can scroll down to a specific section, get the specific numbers that I want, blah, 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 right? I'm familiar enough with these. I don't really care. And there is more information on them. But for the sake of this episode, I don't care. We're going to try to make things simple. So under stockanalysis.com, if you click financials, you'll see income, balance sheet, cash flow. Now, those are 3 sections that are in the earnings report. There's income statement, balance sheet, consolidated, and then the cash flow. And this ratios one right here, that's just kind of calculations based on what these 3 show, okay? There's a lot of them, so we'll skip that. So what we got to do right now is we just got to boil down to what we care about and what we don't care about. And this is a little bit complex because there's many different sectors, and sectors don't always behave equally. So let's say you're in a competition-heavy sector like consumables, or if it's a slow-growing industry, they might have heavier expenses because they have to increase their advertising and compete. So those companies might have slower-growing dividends, but they might also have higher revenue. So it's a little bit of a use your kind of judgment approach. Like financial stocks, for example, they tend to pay interest before they pay dividends. So they're more likely to cut their dividends if needed than another sector. Travel gets impacted by global events. Like we have this conflict in the Middle East right now. They just put out a global travel warning, and that's impacted airlines. So they tend to have more assets because they buy the actual vehicles and the facilities and things like that. But they also tend to have a lot of debt. So their dividends may be impacted differently than a financial institution. So there's all kinds of things we need to consider, but there are still some common elements that we can look at. So ultimately, we're just looking to make sure that the company has enough money to survive, grow, and more importantly, pay us dividends, if that's our approach. And that is definitely my approach. And then the next step is to make sure that they are able to get to a valuation level that makes sense for that company. Okay, so what I mean by that is every company has, all things considered, some sort of level that the share price should be at, and we'll get into the actual calculation of that later on, based on all the supply and demand, their revenue, all their debt, all their assets, everything combined and kind of solved in a mathematical way. There is a defined valuation level that every stock should be at. And if something is super far down below that level, it's undervaluation. If it's overinflated, it's overvaluation, like Tesla was for a long time, and AMC, obviously. So until we can get that number in mind and plot out that map, we have to rely on things like revenue over time, operating income over time, net income over time, free cash flow, dividends per share, and things like that. Now, they're not all super important. Like gross profit, I don't care about. I'm never going to use gross profit to make a decision for me because it's tied into revenue. So what are the things that we can look at and where should we look? So first thing is the income statement. Okay. And right here, it just says financials are in millions. Your companies may say different things. And that the fiscal year is July to June. So that's kind of important as well. I always look on annual for these long-term investments and dividend stuff. And one thing that I just want to look at, first off, I want to make sure revenue is up over years, right? I'm looking at 10 years worth of data. So if I put my mouse over this graph right here and I put my mouse up here, you can see it's 10 years. Okay. So every single one of these bars represents a year's worth of revenue. And as you can see, it's going up over time. So this is a strong company. It's growing over time. That's all I care about initially. If something is all over the place, it's not necessarily a deal breaker, but you need to figure out why. But in the case of Microsoft, this is growing most these years. So if I look here, there's only one of these that's a lower number, and that's 2016. I think a lot of companies kind of took a hit then. But you can see most of the time Microsoft is growing, and that's awesome. That's what we want to see. That's a good, strong company. Next item here is operating income. So this needs to be a solid number as well. It doesn't necessarily need to be growing each time, but you don't want to see a negative operating income because that means that they had to pay money to stay open, right? So that's not a good sign. Pre-tax income, I don't care about that. Net income is probably one of my most important ones, and this I would like to see always positive. And the reason for that is because, again, you don't want your company owing money just for keeping the doors open, okay? So in the case of Microsoft, it's up, it's growing, it's beautiful, therefore it's a strong company. Shares outstanding diluted, that's kind of negligible. I mean, we don't really care too much. That's just saying that they haven't had to do any kind of drastic dilution or conversions of warrants or anything like that. So no trade notes, nothing crazy. That'll really heavily impact the stock. And those are kind of measures that the company can use to kind of manipulate the resources versus cash. Okay. EPS diluted. This is kind of cool. Just a quick gauge, just to see, from an earnings standpoint, it's earnings per share. It's good to see this go up, but it's not a deal breaker, so I don't really care about that one too much. Free cash flow is good. We want to see that the company has extra spending money and that they have liquidity internally. Okay, so this is a pretty good one. I like to see this increasing. I don't ever want to see this one negative, because again, if that happens, your net income is probably negative, and that's not a good sign of strength. Dividends per share, I always want to see this growing if possible. And this is just the amount that they pay. Well, I'll just put my mouse over this so you guys can see it. It's how much they pay in dividends per each outstanding share. So it's a ratio between the float the amount of shares created and the amount of money that they allocate for dividends. Okay, because remember, all the dividend is a chunk of the company's profits that they're dedicating to paying us for owning their shares as an incentive for us to buy and hold their shares. So it makes sense that this should be solid. Right? We don't want that going down and disappearing and stuff. We don't want dividend cuts. Okay, so if I had to summarize the income statement, I would look for revenue, operating income, specifically net income. So net income and revenue are my top two. And then you want to see cash flow, and dividends per share is just nice to have. The rest of it you can kind of ignore unless you're looking at a sector-specific thing. Now we look at the balance sheet, and this is where I really like to look at two specific things. The first is cash and cash equivalents. You can see this is kind of positive too. It's not necessarily growing all the time, but it is positive. And the reason for these little dips might be, sales impacts. They're a forward-facing company. It might be debt that they had to pay off. It could be any number of things, but they're all positive, right? That's what I care about. I don't really care that they're always going up. Next thing here, I'm going to skip over the total current assets and total current liabilities. This is just their short-term scheduled, their available resources for short-term liquidatable assets. So if they have to sell stuff off to pay their bills, for example, they have this many assets. Total current liabilities is their 1 year scheduled debt. So if they close the door, they would have to pay, X number of dollars for the year, just for, obligations that they have. So if this number, total current assets, is higher than their total current liabilities, you can calculate that by simple division. And then that tells you how many years, in theory, that company would be able to stay open without necessarily making money. Okay. So it's a good number to know about, but we don't really care too much about that because it's short term. What I do care about is the total assets and the total liabilities and their relation. So in this case, let me scroll up a little bit. Total assets is increasing year over year. I love that. That's beautiful. There's not a single one of these last 10 years where the assets have decreased, which makes me feel a little bit better about this cash and cash equivalents kind of stuttering here. So I'm okay with that. And then the total liabilities, this tends to increase as well, but I don't want it to outperform the assets. So in this case, the total assets here is 411 million. And the total liabilities is like half that. So this is good. I like that. It's a good ratio. It's about a 2 to 1. Total debt, that's the same thing as total liabilities. It's just a different portion of it. So I don't really care too much about that. I do care about the shareholder equity. So if I put my mouse over this, you can see shareholder equity is the book value or net worth. So basically it's how many insiders in the company or board members or employees that receive shares, how much they're worth after they take all their liabilities away. So this is a pretty good number. You want to see that growing, but it's not a deal breaker. So if I had to break this one down, net cash is good too. Net cash per debt, but again, that's part of the other report, so you don't really have to care. So if I had to break down the balance sheet, I would look at cash and cash equivalents, total assets, total liabilities, and I'd be done. I wouldn't necessarily have to dig into every single one of these. I don't care about receivables for a tech company like that. It just doesn't, I don't care, right? All right, let's look at cash flow. This is where it gets exciting. So again, net income returns to us, right? We always want to see this positive if possible. If it's negative, we need to look into why. All right, so net income positive every single year for the last 10 years for Microsoft. That's awesome. Operating cash flow, this should be nice and efficient, so we should see this number increasing if possible. Not a deal breaker, but we need to figure out why if there's deficits. Investing cash flow, this is only really pertaining to companies that are prioritizing investments like financial institutions. I don't really care too much about this. So we can skip over that. Dividends paid, again, I don't really care too much because that's part of this investing cash flow. Net cash flow is important, but it's not a deal breaker. Now, this representation of it, if you look down here, it's the sum of operating, investing, and financing cash flow numbers. So it's just a calculation. It's not necessarily a deficit in the net income. It's just a ratio between these three. Okay, so if I had to summarize the cash flow, I'd say net income, operating cash flow, and that's it. So just to recap really quickly, income statement, I look at revenue, net income, and potentially dividends per share if you like that stuff. Free cash flow. Balance sheet, I like to look at cash and cash equivalents, total assets, total liabilities. Cash flow, I like to look at net income and operating cash flow just to make sure that's all efficient. And then the ratios are here just for fun. If you want to see the market cap increase year over year, you can as well. I like to see that, but there might be some different reasons behind why it might not. So just kind of keep that in mind if there's a lot of dilution in the stock or something like that. But chances are you're not going to be looking at this company if there are. PE ratio, if you're looking for investments, you want to see this over 15. And in this case, again, it's not a deal breaker, but in this case for Microsoft, since it's a big established company, over 15 is its bread and butter. So that's pretty good. Don't really care too much about the rest of this stuff for right now, other than the dividend yield, but we'll get to the dividends here in a second. But hopefully that makes sense, right? You don't really need to look at every single item. It does help, and if you ever struggle on this site, you can just put your mouse over the text, and it'll tell you exactly what it is. So we can help you learn that stuff, but you don't need to know it. Statistics. This is just a summary of all this information here in the financials. This is important. If you click statistics, it'll bring you here. Go to important dates if you're looking for the earnings dates and ex-div dates, and then that'll kind of tell you what's on the horizon for that company. Now, it's not always accurate, but when they say it's confirmed, that means that the company itself has published that and they validated it. So as long as it says that, that is when the earnings for Microsoft is, and it's after market close, so we can plan ahead for that. Okay. Dividends, again, we'll get back to that here in a second. And this is just kind of summaries of the other stuff, so you don't really have to worry about it. The last stock split for this company, for example, was a forward split 2-to-1 on February 18th, 2003. That's 20 years ago. Okay. So not necessarily the end of the world on that one. But you can kind of look at their margins and all that good stuff if you want to, ROE. But I don't really care too much about that. But it's worth perusing. Forecast, I ignore this at all times. It's completely pointless. Again, all the analysts have outdated models. Basically, you just want to take the targets that they do and apply a specific formula to that. At some point, I'll get into all that stuff, and that'll kind of tell you where the price is likely to get to, but it's never that target. And if it is, it almost never stays. All right, so we've covered the company side of it for the most part. Now, another step of this is just putting in the research. You have to get familiar with the company, figure out what they do. If they have a nice, simple business model, that's usually better because they're more stable. You want to make sure you just read into the headlines, just look at the facts over time, see if they have any partnerships coming up, anything that would cause a change in revenue, because that's really what it boils down to, is how much revenue they get and how much of that is offset by what they owe, and us being shareholders collecting dividends is part of that debt, okay? So let's go ahead and look at this. So again, if you go to stockanalysis.com, you type your ticker in, you click the dividends tab, it'll tell you everything you need to know about the company's dividends, as well as show you a chart. So if we're looking at Microsoft specifically, you can see that it has a dividend yield of 0.92%. Now, it might not seem like a lot, but more importantly, it is stable as hell, and it's 0.92% of this number. So it's about $3. So that's pretty good, right? Now, this is an annual yield, so it's $3 per year with a forward yield of 0.92%. So just keep that in mind as well. So you're not going to get the $3 every single time there's a dividend payout. You get 4 of them per year, and they add up to $3. Okay, so again, it's not the biggest and most aggressive ETF, but Microsoft specifically has increased their dividend payout for 11 consecutive years, and they've grown more than 10% every year for over a decade. So it's pretty good. I like it. IBM's another strong one. They have a 10-year dividend growth of 7.05%. And they've raised their dividends consistently for 28 years. Almost 3 decades they've increased their dividends. So it's good. All right, Broadcom as well. Their 10-year growth forecast is 37.71%. And they've increased their dividends since 2010, so the last 13 years. And that's one of those 3 are ones that I want in my final portfolio. Okay. So let's go ahead and look. The payout ratio here is 30.99%. And I don't know if there's a tooltip here. There's not. But what's important here is the payout ratio is positive and the dividend growth is positive. Now, this is more important if you see a negative dividend growth, like on Verizon, I believe, has a negative one. Oh, no, I'm sorry. It's 1.94%. Maybe I'm thinking of a different stock. AT&T. Okay, here we go. So negative 17.93%. This company's dividends are rough, right? So we're not going to look at AT&T. All right, let's go ahead and get back to Microsoft here. So you can see they also show you the dividend history. Okay, so they show you the ex-div date, the record date, and you can see how far away they are, as well as the pay date. So in this case, it's a quarterly payment. The record date, the date that you needed to have your name in their book at the end of the trading day, was November 16th. You're not going to get paid for another month, which is okay, right? Because you want these to stagger, you want them to roll and all that good stuff. But just understand that if you're someone who's just rolling dividends by the ex-div, you know, you might have a wait before you see that money land in your portfolio. So you kind of just have to factor that into your calculations when it comes to reinvestment. Now, if it's a smaller, more aggressive one like Tesla, for example, you probably get paid a couple of days after or maybe the day after sometimes. Either way, the company has a chunk of the money set aside from their revenue from all their stuff, net cash, set aside a specific amount, and they've divided that by the number of shares they have open, and you get what you're entitled to no matter what, as long as they don't cut the dividend. But once your name is in that book, they're obligated to pay you. So when they pay you, that's a matter of the company, but they're obligated to pay you. So that's why we're racking up these dividend stuff. All right, so right here, this company has an ex-div date, the next ex-dividend date coming up November 15th. So as long as you buy the shares before then and you own them into market close on November 16th, you will get paid 75 cents per share on December 14th, on or before. Sometimes they pay early. It's pretty good. I mean, if you're someone who's just rolling ex-divs, that's 75 cents just for investing, you know, for a day or two. That's really, really good. So, you know, you can buy it on or before the 15th. You sell it after the 16th, you get your name in the book, and then 2 days later you get paid. Easy way to make 75 cents per share as long as you have the money to buy the shares and that it fits in your plan. Okay, so in my case, you know, if I'm looking at the spreadsheet, I have an investment allotment of $840 right now, but in November, I might have a little bit more money, and I might be able to swing $300 for one position, which I won't, unless it's one that I already have. But just know that I could. And that is exactly what would happen if I did. I would get that 75 cents for that one share. I'd get paid on or around December 14th, as long as I had them up and through these dates, November 16th, November 16th specifically. Okay. So when it comes to dividends, and if you want to scroll down here, you can see that there's dividend charts down here. 2013, November 2013, the dividend was 28 cents per share. Okay. Today, it's 3 times that. Well, not today, next month. It'll be 3 times that. Okay. So really good year over year dividend growth. That's pretty good. And here's the dividend growth. So if you look at the difference between this level and this level, it gets plotted here. So 10%, 16%, 8%. So they're really consistently decent dividend increases that you can see here. You know, 6 to 10% in most cases, sometimes higher. That's a really solid dividend growth. Okay, so if we look at Tesla, for example, just a comparison, it doesn't have as much data. But you can see here the dividends are kind of all over the place, and that's because it's a benchmark ETF with less weight in diversification. It's got most of it is in the treasuries, and then it's got Tesla and some synthetic covered calls and things like that. So it's very disproportionately weighted as opposed to Microsoft, which is a company. It doesn't have holdings like that. That's a different company altogether. But when you're looking at dividend-specific ETFs, you're going to have to look at those holdings and figure out if that's something you're comfortable with. So when it comes to what I look for in companies, it's just to make sure they are making money. They have been making money. They will continue to grow, or they should continue to grow, and that they have enough to give to me. All right. So we're taking something really complex and we're making it really, really simple. And how we trade it, how we collect that money, there's any number of ways. What's important is that we determine which path we want to follow, and we follow it to the letter. You know, the more consistent we can be, the more profitable we'll be. So this is a much longer video than I intended, but I just wanted to address some of the questions based on, you know, what I look for specifically. And if you are someone who has an altered selection, say you're in Europe or something, That's ultimately what we're getting at. We're just trying to figure out which companies are making money, or which dividend ETFs are efficient. Check their history, check their performance, make sure that the growth is there, not just the high yield stuff. And if it's not, understand that it is a short-term risk and it's not necessarily something you want to hold for 10 years. And just kind of use your best judgment and keep asking those questions. So let me end this recording here and I'll upload it. And you guys all enjoy your weekend. And we'll be back next time. Thank you. Bye.